Well, as we've noted, investor interest is high, as it always is, in those results coming from Nvidia after the close of trading. Also being watched today is the possibility that U.S. President-elect Donald Trump's nominee for the position of Treasury Secretary could be named. Our next guest is positive on stock markets and does expect the bull market we have seen thus far to continue. Let's welcome David Burrows to the show. He's President and Chief Investment Strategist at Barometer Capital Management. Thanks for coming in.
Great to be here.
Why don't we start with the Nvidia numbers? There's always a very strong amount of interest in those numbers. Yesterday, the stock rose 5% as investors got ready.
Yeah, you know, it's one we're all watching, and it's a stock that we kind of have to own, and for good reason, right? The growth has been quite unbelievable. It comes against a tricky backdrop because the semiconductor sector has been underperforming since July. I think only about 30% of the companies in the sector are in uptrends, and that's been deteriorating over time. So a lot of weight on the shoulders of Nvidia. Having said that, you know, I think that investor expectations probably are reasonable coming in here. There were things to worry about over the course of the quarter that maybe held people back. But the Blackwell chip issues seem to be behind the company. And all of the various hyperscaler purchasers of their chips have been warning their investors they plan to spend more than maybe they had expected. So the number should probably come in pretty good. The question will be, how does the stock react coming out of it? You know, it's always great to see a stock hold up near the highs when the sector's been very weak. The risk is if the sector gets weak enough, it drags down the leaders. But in this case, we'll see. I think the numbers should be pretty good.
You refer to it as a stock you've got to own. What's your message to investors on how much they should own in terms of a proportion of their overall portfolio?
Look, you know, we think that a diversified portfolio is 20 positions, and we own 3 to 5% weights. And there are times when certain stocks become much bigger parts of an index. That's great. There's other things to do. It's a company that we own, but we don't own a market weight. Okay.
On broader markets, we've seen markets rise post the U.S. election. You believe, however, that in the longer run, investors need to be cognizant of inflation and the risks that inflation poses to their portfolios and their wealth.
So we have really two jobs as managers. One is to recognize changes in the market, be able to identify the key things that are being revalued and focus on those areas. But second is to help clients manage risk. And for a long time during a disinflationary period, the risk was falling prices, which is why, you know, fixed income gave similar returns to equities over a long period of time because rates were falling. I think really the big risk that we have to deal with today is that inflation eats your money. And so we have to own things that have a capability to offset that and maintain purchasing power. And those are things that benefit from an inflationary environment. History says that when you have an inflationary bout like we've had, after a lull, you're going to have a second bout, and then maybe a third and maybe a fourth. So certain industries and companies have an ability to generate lots of cash and have an ability to grow their dividend over time. And a rising dividend, of course, offsets a rising cost of living, and we think those are really attractive characteristics to have.
One sector you think fits that description very well is the financials, and that, I believe, is your largest sector position now at Barometer.
Yeah, by far. About 28% of our firm assets are in financials. Now that's banks, insurance companies, regional banks, some fintech, but...
And is that both U.S. and Canada?
U.S. and Canada, and frankly, we do have some global as well. But the fact is, during 40 years of falling interest rates, the power was in the hands of the borrower, lower cost of capital over time. Since 2020, that's all been reversed, and the power is in the hands of the lender. And so if you think about it in the most simple terms, you know, the financials are the source of capital. They probably have the best opportunity, but there's other companies that generate lots of cash that gives them flexibility.
You also like industrials.
We do, because at the end of the day, it's supply and demand. If their costs go up today, they can raise their price tomorrow, assuming they have an attractive product. And we are in a world where we're seeing reshoring of manufacturing. We're seeing a turnover to more automated manufacturing. And industrial companies have that ability to have pricing power.
How do the commodities producers fit into this?
Well, look at, you know, I understand why people have a negative view of this industry. They see it as an old economy industry. But the fact is, you can't build anything without materials. So, you know, when you go through a 10 or 15-year bear market in commodity prices, it means that companies stop investing in new capacity. And ultimately, you wind up with a supply-demand crunch. And we think there's lots of commodities that are in relatively finite supply with growing demand on the other side. And we can see that it's going to take years for new capacity to come on, which means, again, having pricing power and the ability to generate cash.
Does that include oil? And the reason I ask that is I speak to some portfolio managers who are reluctant to invest in this sector because they think predicting the price of oil is a mug's game.
Yeah, and I think that that's tricky. In the very short run, prices do move around. I think it depends on the kind of oil company you're talking about. If you're talking about a shale oil company that has a very short reserve life, well, that doesn't look very good. But we think that the long-lived assets, the companies in Canada that have 50 years of reserve life and have made the investment in their production capacity, we think that's a big cash-generating business, especially because companies like Imperial and Suncor and CNQ have paid down their debt and made commitments to return capital to their shareholders. That's very friendly to shareholders.